So today, since it is the starting of a month, let's look at the market outlook for June, how we are going to position, how markets are positioned, and how we are going to align our clients' portfolio so that we can generate the maximum alpha. So before going to June's outlook, let's look at what all happened in the last few months and how they affect the coming future. So let's look at the global debt capital markets. The key highlight was that all the central banks are becoming less hawkish now. The interest rates are subsiding because in general we are feeling that the inflation across all the economies is now plateauing. That's a general trend, but not true for all the countries. So what all happened? There was a banking distress across US where continuous hiking of interest rate did put a run on lot of regional banks in US, so there had to be a bailout by the government, but the best part is the contagion risk is now subsided. So because what happens is banks are always interlinked. This is what we witnessed in the 2008 crisis, that all one bank or the other holds securities of the other. So now that contagion risk has been contained, and we are not going to see any more defaults expectedly in coming future. But the core inflation, that elevated inflation, is still on hold. That means it has plateaued, yes, but it has not decreased. So inflation is still high. So we have to always keep a watch on it. Federal Reserve Bank of England and European Central Bank did raise policy by 25 basis points in their May meeting. But what is good side is that several Asian banks like India, Korea, they have stopped their hiking cycle. They have put a pause on it, and they're going to now see that how other countries behave and with what are their internal macros, and then they're going to make a decision on it. New Zealand, whereas increased interest rate by 50 bips, and Australia raised the interest rate by 25 bips. In Australia, the central bank has not been able to control inflation, and they have steadily risen the interest rates a lot, and that is a key challenge for Australian GDP. Now let's talk about global equity capital markets. Most of the equity markets across the globe have come out of the sluggishness, and they are showing some rally. May performance have been impacted by slower than expected growth of China. China is still not able to come out of the the after effects of COVID. The economy and various countries are still shut down, and overall industrial complex, because they have lost a lot of lives, that is a good loss of labor. They are still struggling with their internal credit crisis. Most of their real estate builders have not been able to pay on their loans and on their dues. They are restructuring their debt year on year and month on month, so that is one challenge. But what is more important and key factor one has to look at, there has been a strong rally in AI stocks. So obviously after the launch of ChatGPT, everyone is now very fond of using that. But there has been a strong rally in AI because especially if I talk about NVIDIA. NVIDIA is one company which manufactures GPU, graphic processing units, and its allied softwares, which are very important now for AI tools, because all the AI companies have now have realized with their research that rather than working AI engines on CPU, it is better to run them on GPUs. So they're slowly transitioning to a lot of GPUs, and NVIDIA is one of the biggest players on them. There are other players like ARM and Cadence, but these are all private companies and not listed. So let's talk about Indian equity markets. So Nifty 50 TRI was 2.9% up in May, but it still underperformed the broader market index like Nifty 100 and NSE small cap, which rose by 6.2 and 5.1% respectively. Auto sector was one of the best performing sector because of the strong FI inflow and realty also. So these were the top two performing sectors. The worst performing sector for the last month was PSU banks, which just was down by 2.8%. Overall, owing to the time correction, the current price to earnings ratio has decreased to 18x in the latest cycle. This has brought the valuation in rather a very comfortable zone. And Indian equities are especially very much lucrative right now for global investors to put their money into. But we have to understand that this price to earning is not decreasing only because of price correction. It is also because the growth earnings is also decreasing, and while index remains almost constant still since October 2021. So let's look at some economic parameters which are driving the Indian markets. The GST collection is up by 44%. That is a very good number. Approximately from 1.3 lakh crore to we have risen up to 1.9 lakh crore in this year. The Nifty earnings is up by 16%. That is a very good sign. Inflation was 5.7% from its peak 7.8%. Now it's down to 4.7%. So it is a good number where we are talking across global economies that inflation is not subsiding. We are able to see that whatever steps the Indian Central Bank has taken, it is coming into effect, and which is good. Brent is down. Obviously, it is helping us in decreasing our overall current account deficit. And since we are purchasing maximum of our inputs from Russia at a very discounted rate, it is also helping the overall current account deficit. Credit growth is good. So it is a very healthy phenomena where we are seeing that though interest rates are rising, there is a demand of credit. So which is a very good sign that credit growth is healthy. And the monetary policy is almost over, but RBI deciding to keep the interest rate unchanged at 6.5%. So let's talk about the FIIs. FII also return as net buyers now, which is a very good sign, and it is the right time to take positions where FII is putting money into the Indian markets. The only challenge here lies is if due to some uncertainties, the overall yield in US rises, then you might see some outflows from FII investors, but that is yet to be debated. This is the first instance where for consecutive 3 months FIIs have poured in money. So that is a very important data point to look at. DIIs on the other hand have been net sellers, because obviously they have been holding the Indian markets for so long. They have been holding the fort while FIIs were not there. So it is the right time for them to book profits. In the same period, IT saw an outflow. Obviously, IT is not yet well performing in India. So that is one we have to look at. But if you look at the long term of IT, we have to see that companies which are based out of India, these all are service-based companies like TCS, Infosys, Tech Mahindra. So yes, obviously, there is always a headwind, that if I talk about 5 years back, people used to say big data is going to be the next big thing. And it will make all these service-based companies redundant. Market logistics will make all these companies redundant. But what happened actually was once a technology comes, who will be there to service them? So obviously, at the end of the day, TCS, Infosys, all these companies had to actually build softwares based on these technologies. So you create a technology, and then the service provider creates a service platform on it. So yes, there are certain short-term uncertainties in the IT sector. But if I talk about AI and all of these, new technologies that are coming in, I am dead sure that Indian services industry will be the one implementing it for the global market. So if someone is investing for a long term in IT, these cheap valuations are good. So let's talk about the outlook. So going from today to 2024, you might see an after effect where if inflation is not controlled, global interest rate might have a few more hikes, which will in turn might force RBI to also increase our hikes to make our bond yield lucrative. But yes, due to the development of global banking system and de-dollarization, which is less dependence on the dollar in the global markets, we might see some volatility. So volatility is a double-edged sword. It's how you look at it. Volatility can be good for your investors to generate higher alpha. It can, someone who is not very careful, he might incur losses. However, on the domestic front, we are looking very good. India is primed as the only economy across, across Asia and globe, where all the foreign money should flow right now, because we are very much stable on our inflation part. Our macros are supporting it. The government policies are supporting it. Obviously, 1 year ahead there is an election, so government will launch a lot of schemes to promote foreign investors and to do a window dressing. If you speak on that, So with these improving economic parameters coupled with inflation turning the corner, obviously in India inflation is turning the corner. We are not just seeing that it is plateaued, it is also going down. I believe that it is a valid sense to deploy money into equities in a staggered fashion. Obviously we are again at a 62, 63 level, so putting all the money right now won't be wise, but yes, in a staggered fashion one can always deploy into equities and gain the overall profit, because you need not to see that we are again at our high, because you cannot predict what is the next high, right? If today it is on 62, 63 level, might be if you wait and keep your money in cash waiting for the next dip, and after 2 to 3 quarters you reach at 65 or 67 levels, then you have a loss of opportunity, right? So it is very important to deploy the money in the staggered fashion. So with that, thank you so much. I would open this house for question and answer.